Hello, everyone. Um, well, it's early afternoon here on the East Coast, still in the morning on the West Coast, but it's the evening as well on some of you in Europe, UK, and even Africa. Welcome. But I must say, there's also people here live at night from Asia, from Japan, namely. So welcome, everyone. I'm Michel Criard, 2020 Global Chair of the Councilors of Real Estate. Welcome to the launch of the What's Next for Real Estate and Life Experience, a series of monthly webinars presented by the Councilors of Real Estate, a global membership organization of credentialed real estate problem solvers. Members of the Councilors advise institutions, corporations, investors, government, public authorities, and nonprofit on how to maximize their real estate asset and portfolios. They are principals of real estate, financial, legal, valuation, and accounting firms, as well as developers, economists, innovators, capital market professionals, and leaders of academia. Members are awarded the CRE credential, the Councilors of Real Estate, a designation signifying achievement and exemplary skill in all matters related to real property. I'm pleased to introduce you today two particularly insightful councilors, Richard Barkham and Kenneth Riggs. Richard and Ken will not only interpret the effect of the COVID-19 crisis on property market worldwide, but address its impact on society and the emerging opportunities in real estate and the financial markets. While attendees will be muted during the course of today's event, you're encouraged to utilize the Q&A feature at the bottom of the screen. Should you wish to submit a question, we welcome them and we'll answer as many as time allows. Richard Barkham is Global Chief Economist and Head of America's Research for CBRE, widely recognized as one of the world's leading economists and real estate advisors. Richard is also a visiting professor at the Bartlett School of Architecture at University College London. He holds a PhD in economics from the University of Reading and has been a member of the Councilors since 2015. Moderating today's session is Kenneth Riggs, Vice President of Citus AMC Real Estate Research Corporation and its Real Estate Evaluation Solution Division. Ken is publisher of the quarterly RERC Real Estate Report and co-publisher of Expectations and Market Realities in Real Estate. He holds an MBA from the University of Chicago and served as chair of the councilors in 2012. So welcome, gentlemen. Ken, I'll now turn today's program over to you.
Thank you, Michelle. And I'd say to all my colleagues, fellow CREs, I do miss you, and it's nice that we can at least connect in this manner. And my comments before turning it over to Richard are really brief. I would say first, there's no words to describe where we are in the world today. I would quote Warren Buffett said, because I've seen a lot of my life, but he goes, it's taken 89 years to see something like this. And then with Richard, he will focus on the future. And I do view it's a very important perspective. And as we prepared for this webinar, it made me think of the quote from Gretzky. And Gretzky's quote was that you skate to where the puck is going, not to where the puck was. So with that said, I will turn it over to Richard. He will give a presentation with some very insightful slides and discussion, and then we'll have time for a Q&A session. So Richard, with that, welcome, and please, I turn it over to you.
Well, thank you, Ken. And with a view to skating where the puck is going, or hopefully, I've entitled this talk Moving On from COVID-19, because I think even though it's early in the day to say that, I think it is worth saying that, and we need to think through where the world will be post-COVID-19. So that's the title. Let me kick off. I've got three sections. I've got one on economics. I've got one on hunting for green shoots or green shoots of recovery, and then a section on the world post-COVID-19 and what it might look at. So let me talk you through those. So why do we think that we might be in a world post-COVID? I think it's partly this slide. We're past the peak in new infections. Asia has been very effective at suppressing the virus, perhaps the world leader. But Asia had the SARS experience to rely on and had a certain amount of skill and expertise already. It's the virus has caught other countries a little bit napping, and it's taken them a while to adjust. But I'm pleased to say that we are past the peak in new infections. And even if the USA and the UK are trending down a bit more slowly, they are trending down. But despite that optimistic news, I think it's quite clear that COVID-19 has brought an end to this economic cycle. And I like to measure the economic cycle by reference to US unemployment. And you can see 6 cycles since 1970. And they typically, you know, cycles, when they come to an end, they do come to an abrupt end. Unemployment does shoot up pretty rapidly. But I don't think we've seen, as in the words of Warren Buffett, I don't think we've seen an end to an economic cycle quite as abrupt to this. And of course, this is not a direct response, a direct result of COVID-19. It's the lockdown policies that have been put in place to control the virus. In the absence of a more sophisticated virus testing and tracking and isolation regime, this lockdown methodology has been used to control the virus, and it's extremely economically destructive. And that's what's brought the current economic cycle, which was a long economic cycle of nearly 11 years, to an end. All of that said, I think, again, referring to US unemployment, and I think the US is still an emblem of the global economy. If the US is doing well, typically the global economy does well. But looking again at unemployment, perhaps with a shorter time span here, we see that unemployment is going to peak out at around 15% by the end of Q2 in 2020. Goldman Sachs, I think, released a forecast yesterday that pushed that number to 25%. And indeed, it might be a little bit higher than 15%. But the key point with both the Goldman Sachs forecast and our current house view is that we see a relatively quick recovery, at least a quick partial recovery, with, I think Goldman Sachs see unemployment coming down to around 10% at the year end. We see it closer to 9%. But I think there is the prospect that the massive shock to the economy that took place in Q2, which has been pretty brutal, can be recovered quite quickly. I'm not suggesting that we'll go back to the level of unemployment that existed prior to COVID-19, which was a record low of 3.5%, but we will be able to partially recover in the economy quite quickly. Why do I think that? Why do I think that the economy can recover quickly? Well, there are a number of factors behind that. One of them is this, and again, this probably just looks like a squiggle on a chart to most people. But what it is, it's in economic terms, it's the private sector domestic balance. Broadly speaking, it tells you whether the private sector, which is all households or businesses, was net saving or net borrowing prior to COVID-19. And you can see that in most recessions, it's a chance for the private sector, and those recessions are highlighted here by kind of those narrow grey bars. It's a chance for the private sector to reset itself and to get its house in order and become a net saver rather than a net borrower. And you can see that prior to the past 2 recessions, the US private sector had been a large net borrower. But in actual fact, if you look prior to this crisis, the aggregate US private sector was a net saver. Its finances were extremely healthy. And because it was a net saver, it had been able to build up cash buffers and liquid asset buffers. Now, though they're not huge liquid asset buffers, but that we've looked at corporate sector balance sheets in the United States, and there is enough liquidity there to see the US corporate sector through a really rather acute shock to the business for at least 1 quarter. So the point is that US private sector was pretty well positioned prior to COVID-19. So that's one cause for optimism. Another, of course, is just that the Fed has learned a lot from the great financial crisis. And it's not just the Fed. Central banks around the world have been really active in supportive monetary policy, intervening in financial markets, creating liquidity for companies, creating liquidity for different parts of the market. You can see just how much the Fed's balance sheet has jumped. You know, it's done as much in two months as it did in the great financial crisis, almost in 3 or 4 years. So the experience of the great financial crisis has allowed the Fed to be really active. And the same is true for other central banks around the world. So that's another cause for optimism. And of course, I think, you know, partly the politics of the situation, that the government was seen to bail out the banks in the great financial crisis. I don't think any government around the world can afford to not appear to be bailing out the common man now. So, and this is just the United States, it's the uptick in government spending. A massive stimulus has taken place, government stimulus with direct support for business and individuals. We've seen the same in the UK, we've seen the same around the world. In fact, the Japanese government is the biggest fiscal expansion. But I think as well as this, following what policymakers are saying very closely around the world, there is another wave of stimulus coming. So once we get through the crisis, I think that governments will produce one more kind of big stimulus to make sure that the recovery gains traction. So I think those are kind of 3 reasons why I'm optimistic for a bounce back. Just a little bit of note on economic terminology here. You hear a lot of big numbers bandied about in terms of the United States. And I've just looked at our forecast for GDP growth, and I've looked at it in quarter-on-quarter terms and year-on-year terms. So when people talk about the US economy shrinking by 36% in Q2, that's a quarterly annualized. It's a quarterly number of about 8 or 9% times by 4. And it's what the economy would shrink at over 4 quarters if it continued at that rate. You know, the bounce back of 29%, that's a growth of about 7 or 8% multiplied by 4. If you look at this on a year-on-year basis, the magnitudes are quite big. It does show that a 10% contraction of the US economy by the end of Q2, but the numbers are just a little bit more, and the trajectory is just a little bit more understandable than some of those big quarter-on-quarter changes. So, you know, people talk about a V-shaped recovery. When we talk about that, we mean it only in this very narrow quarter-on-quarter sense. Many other variables, economic variables, will have what I call a Nike swoosh path to recovery. And I think this is how we see it for the global economy. I think over the last week or so, economic forecasts have edged down a little bit and seen a little bit worse economic growth in 2020. But, you know, a lot of big negatives out there. But I think that the consensus is still, you know, fairly solid that the recovery will begin in Q3 and extend to Q4, and then will produce, you know, pretty strong rates of growth in 2021 when the virus is past, when the economy has restarted, when pent-up demand is released into the economy, and when it is consolidated with the current level of economic stimulus and more economic stimulus to come. I don't think this is, I think this is the mainstream view right now. So, you know, to what extent has it begun? You know, let's have a hunt for some green shoots. I mean, I think I must say it's a little bit at this stage like hunting for a needle in a haystack. But if you spend enough time and throw enough resources at it, you can find the needle, and I think I have done. So what do I think? You know, I think the fact that the stock markets have recovered some ground, have had a bad week, I think, but they've recovered some ground means that they are cautiously optimistic on the future. They support this. They see the downside risks, of course they do, but the markets are telling us that this kind of medium-term revival in the economy is on balance the consensus view. Very interestingly, I look at risk spreads, and even now it's incredible just how the fact that debt markets haven't closed. I wouldn't say they were vigorous, but all our market professionals are telling us that debt markets are open, and you can see that risk spreads have started to compress quite meaningfully, and indeed risk spreads never approached those of the great financial crisis. Most cycles bring themselves to an end by excess leverage, over expenditure, overextension of businesses, but this isn't an internally generated end to the cycle. It's an exogenous shock on an economic growth trajectory, which was quite sustainable, I think. Anyway, risk spreads coming down. Interestingly, having a look at the yield curve, and you know, there was a lot of debate. If you look at the timing here, but in 2019, there was a lot of debate about this inversion of the yield curve. Did it mean recession, or did it not? And I think we all argued at the time that probably the inverted yield curve didn't mean a recession. But you know, clever old financial markets, you can see somehow or other the bond market was pricing a recession, and sure enough, a recession has come along. But it's quite interesting also to note that the yield curve is not now inverted. So it's flat, but it's not inverted. So again, I think that's supportive of the growth hypothesis. It's quite interesting that REITs have recovered much more quickly than they did in the great financial crisis, with not only a partial recovery, but it's a trajectory that is better, less pessimistic than the great financial crisis. Looking abroad, or looking overseas, China is, I think, furthest ahead in the economic recovery, and I've got a couple of economic data points from China. This is a little bit of a complicated chart, but hospitality is a good barometer of the economy, hotel occupancy. And history tells us we've got some really excellent hotel research on our platform. And, you know, we've looked at 101 different crises, and hospitality, or demand for hospitality, always comes back. And it is always reflective of the state of economic prosperity. And you can see on this light green line here, you know, the big drop in nearly, you know, from 70% occupancy down to 10% in the case of China. But now it's coming back, you know, and it's following a trajectory that we pretty much, we mapped out on the basis of the, you know, previous crises. And indeed, the same is true in the United States. Occupancy has dropped off, beginning to come back, perhaps a little quicker than people ever expected, but still a Nike swoosh there, but some optimism from the global economy. And look at China trade, you know, clearly was pretty weak due to COVID, but now is beginning to, container freight beginning to look up again. And China still in some senses the workshop, the kind of workshop of the world, and also an important market in its own right. So I think the bounce back in China is pretty solid and pretty good news. A couple of other things. It's very difficult to track the economy on a week-by-week basis, but people are trying to do this now. So people look at the Open Table online restaurant booking service, and you can see a little bit of life in the restaurant sector, not too much at this stage, but Germany nudging up. See a little bit of more life in the United States. And I expect that to bounce back pretty strongly. But I think in the United States, the substantive move out of lockdown, it'll be earlier in some places than other, but I think in the United States, the substantive move out of lockdown, probably because the United States is a little bit behind in terms of the suppression of the virus, the substantive move in out of lockdown will take place mid-June. But I think even with that mid-June trajectory, that's still good for a Q3 and Q4 recovery. But we will see this beginning to notch up in the next few weeks, but substantively up from kind of mid to late June. Not so much movement in the travel sector. This is TSA Chatpoint travel numbers. It's looking up a little bit, but again, I think this is likely to pick up mid to late June as the economy substantively in the United States moves out of lockdown. It'll be ticking up in other economies more quickly than that. One other little snippet of good news. CoStar has tracking multifamily daily asking rent, and you can see that the decline in rents in the multifamily sector, thankfully, and I say thankfully because I think it represents a degree of easing in that market, but the decline in rents easing substantially there. Suggesting that the aid to families without resource and is beginning to flow. So beginning to think about the world after COVID-19, I think this is not a fully worked thesis, but it is one that we need to start to flesh out. There's some key questions. How quickly do we move out of lockdown? How does real estate recover? And one of the front of mind, I've stated it quite boldly, but you know, people are wondering about the office. Will we ever get back to the office? Does this throw, you know, the kind of workplace that has dominated the economic landscape for the last 70 years, you know, the future of that into some sort of question? And the other one is, will manufacturing, I think, be restored to the US? And I don't just mean the US. I mean manufacturing, again, for the last 40 years has generally drifted towards Southeast Asia. Will it now drift back to higher cost locations in the United States, Europe, Japan, and other parts of the OECD? So I think these are some of the key questions. This is how we see the progress out of lockdown. No getting around it. It's going to be slow. You know, and you can see where I've plotted different companies, even at the top end of this curve. And maybe each of these segments is about a month or 5 weeks. You can see that you know, people jog through this relatively slowly, and even at the top end of the curve, it's only 70% of normal life, but 70% of normal life will allow economic growth to recover. But you know, many countries are still, you know, some weeks away from getting to that point. Again, I wouldn't want to read too much into these forecasts. These are very much initial estimates, but this is, if you look at the dotted line is where GDP growth would go to if there hadn't been a COVID crisis. The hard green line is the hit to GDP, and the Nike swash bounce back in GDP in terms of levels. There's a permanent cost. GDP never quite gets back to where it would be. But you can see there's going to be a rental disruption and probably a capital value disruption as well. Now, with all of the activity that the central bank, all of the deployment of the central bank's balance sheet, we've noticed in some of our economic models that, you know, when you get a surge in quantitative easing, cap rates, it tends to be positive for cap rates. Cap rates tend to compress. So it may be that this kind of this scenario of capital values is not quite as acute as I've mapped it out here. And it's certainly not going to be as bad as it was in the great financial crisis. But there will be rental loss, and there will be rent, and there will be capital value loss, at least for a period of time. In terms of something slightly different, in terms of looking at the way out of the crisis, in terms of leasing, So this is an index of leasing, and we've probably got a 1 year, 2 year, 3 year recovery scenario for US real estate. We see very much a Nike swoosh shaped recovery in all of our sectors. And, you know, we see probably the industrial sector coming back most quickly because COVID-19 has definitely given e-commerce a strong nudge in its favor. And we may even see some secular shift upwards in leasing. We may see, you know, even if there's a 1 year recovery for leasing to get back where it was prior to COVID-19, you know, beyond that, we might see some further increase in levels of leasing just because of the power of the growth of the digital economy. In offices, we see much more of a 2 year recovery. You know, a big drop in office leasing in Q2. The difference between the hard line, the dark and the light here is just it's the difference between renewals in place and leasing of new occupancies. And clearly renewals in place are going to dominate the market going forward. And we see more of a 2 year recovery in the office market. But we do recognize there is a zone of debate about the leasing recovery. And I am in the camp that in the medium term, there is no damage to the office sector. But I think there are others who are asking questions about the future of work and the future of offices. So I think there is legitimate zone of debate around this. And then in the case of retail, we have a 3 year recovery scenario and potentially some secular downshift of activity that's lost from retail to e-commerce might permanently affect leasing. Now, this is not to say that the retail sector is going to be anything other than vibrant and dynamic, and you know, great places are great places, and retail are part of that. You know, a lot of goods are going to continue to flow through bricks and mortar. Nevertheless, you have to think with a positive shift to e-commerce, there is some impact in the medium term on retail leasing, and the recovery will take a longer period. Now let's go back to the issue of offices. Again, people are asking questions about the future of the office, and I just wanted to put here, going back to 1990, this is just the grey lines here are occupied stock and vacant stock. You can see what a smooth upward trend in office usage, or the stock of offices, is in terms of billions of square feet. And it's clearly related to the growth of office using employment. You know, this is a forecast. We see, even if it eases off, I think office use employment is going to continue to grow, and there will be a hit medium term to the office sector. And I think, you know, some of the areas that may be serviced by mass transit are going to lose competitive advantage relative to suburban office, where you can go to work with a private car. But the idea that the sector is under threat, there's no economic precedence. This is a very large, very stable long-term profile. And I think any sort of impact from COVID-19 is going to be short and medium term, but it's not going to disturb that upward growth in the stock. What we will say is that the nature of the workplace is changing. This had already been happening. People had begun to work more from home. People begun to work, you know, some work from home. There is just a general greater fluidity in workplace, in work organization in the service sector. So I think that's going to continue to grow, and we may see more of a hub and spoke kind of model, and more high amenity offices, you know, to cater for people being a little bit more kind of peripatetic. The workplace will change, but I don't see it affecting overall office demand. And some of these themes were a little bit of a plug for CBRE research here. We released this report just prior to COVID, and COVID but it's available on our website. COVID's rather taken over, but we talked about some of our ideas about the fluid workspace are in that report. And indeed, we put a lot of emphasis in the report on the emphasis that corporations will have at a senior level about creating places. But that's taken on a different kind of aspect, I think, post-COVID, because part of that place-making job is making people feel secure in a post-COVID environment. But nevertheless, that's all fleshed out in that report. Do I think that the other thing is people are talking about, just how vulnerable the supply chain is in the advanced world, particularly around medical procurement, but not only in terms of medical procurement. Here, I think I'm a little bit, there is a reason why manufacturing activity is offshored from the developed world over the last 40 years. It's just a lot cheaper. And it's not just about labor costs. It's about a whole wave of productivity gains that can be accessed on a global scale when you get these global clusters of manufacturing activity, as you do in Southeast Asia and Asia more generally. So I think, when people look at the cost of reshoring, then I think it's a lot more difficult to achieve. But I do see, some reshoring of manufacturing activity, particularly around medical procurement, and maybe also automobiles. They're the ultimate swing industry that it can locate in low-cost locations or high-cost locations. I see some reshoring taking place COVID around building a degree of resilience in certain supply chains, and indeed more generally than that, kind of a revival in manufacturing activity. But I don't see that will be overwhelming. And will politics change? Well, I won't go through this chart, but one thing these charts can be circulated. I do notice that post the Great Depression in the United States and after World War II in the United States, there were really big extensions of government into the economy. And we've seen a very major increase in government intervention in the economy to support the economy just over the last quarter. I think it might be quite difficult for governments to withdraw from that in the medium term. And that will shape, I think, probably a different kind of politics. But I think that is still to be thought through in greater depth. So conclusions, we're going to move slowly out of lockdown, but we are moving out of lockdown. Real estate recovers, but not in a V shape, in a Nike swoosh. Is the office dead? No. Is the workplace going to change to more fluidity? Is suburban space going to benefit relative to core? Probably. Will manufacturing be reshored to the US and the developed world? A little bit, I have to say, but not overwhelmingly. So, Ken, I think I can hand back to you now for the question and answer session.
Thank you very much, Richard. And I think you provided a very solid, I think, approach to, where we are. And there's a question that's coming through that we're filtering. But a consistent theme is the fact that, there's just one, we don't have a vaccine. And there's concern of a second wave, as we start to open up the economy here. And the questions generally revolve around your economic outlook. What does that factor in relative to, the COVID-19 potential second wave? Is your forecast reflect that? Or what would happen if we have another second wave of, again, COVID-19?
Yeah, I mean, I think it's almost certain that we will get a second wave. I mean, that's almost baked in. We'll be very lucky if we don't. But I think what part of the purpose of lockdown was to both create a situation where medical capacity could be expanded, but also gives time for the 3 T's, technology, tracking, and testing, technology and tracking. And I think that, it could have happened quicker, but I think that kind of range of ability to test, ability to track contacts and selectively lock down people effectively gives the ability for a much more sophisticated response to the virus that allows economic growth to continue even despite having a second wave. So I think, I mean, that's clearly been deployed in Asia very successfully. And it's taken a while, I think, for Western governments to get their act together with regard to the 3 Ts. But I do see, you know, talking to people who are in contact with governors around the United States and in the UK, just the development of testing and tracking, people are being hired to do tracking. That our forecast factors that response in.
And I think something that, you know, ties into that is questions and, you know, in the back of my mind, you know, like New York City, you know, major metropolitan areas that depend on mass transportation. And, you know, even for our office in New York, they're not sure when they'll, let's say, suggest that professionals come into the office. It might be into early next year. So the comment or the question is then, is how do we overcome that? You know, the dependency on Metro and using the downtown. So you mentioned it briefly about the suburban offices may have some more attraction because you can take your car there. So the question is, how big of an impact will that have, the dependency on trains, mass transportation in these major urban locations, New York, San Francisco, and other locations?
It's quite interesting you should say there are lots of different answers. I mean, I think just to state quite clearly at the outset that, you know, this kind of urban density that we've seen over the last 20 years exists for a reason. It's because it produces creativity and innovation and high levels of productivity. So, you know, it is the idea that that will go away in the longer term, I think is fanciful. It's very highly productive. And people have got used to living in very kind of rich urban environments. And I was just listening to the British news. Britain is kind of, I think people went back to work yesterday. The order was issued that those who could go back to work should go back to work. And, you know, mass transit was pretty brisk, pretty active. So I think we will be surprised by how quickly mass transit comes back. But I think it's a number one concern for corporates that will want to make sure that people reoccupy the downtown offices in a cautious and safe way. Companies will respond to an end to the lockdown by kind of managing the re-entry into the workplace to make sure that social distancing takes place. And clearly, I think there will be a level of social distancing imposed in mass transit. So I think a combination of, you know, social distancing, cautious but probably higher than expected usage of mass transit, and, you know, the continued rollout of the 3 Ts, testing, tracking, and the 3 Ts, you know, will allow the big urban centers to gradually come back.
Okay. Yeah, there was a little breakup in your delivery. And before I turn it over to Michelle, I think a similar question is, when I started in the industry, it used to be average square footage per office employee was close to 250 square feet. And over time, you know, I'm dating myself back from the 80s, they changed and I'm looking out at our office here in Houston, the format where, you know, there's much more open space, shared space, you know, density of individuals, you know, sharing the common areas, and there's very few offices there. So what comment would you make then about now today where we have shared office companies that are quite prevalent? We have our office set up here is made for that high density, everyone put together, all common areas. What, how does that play out then? Does that stay the same, or will we change the shared office concept?
Well, I think, you've got to think that, I mean, these things take place over quite a long time, but at least in the short and medium term, the density is going to go down, just to make sure that there is an adequate amount of social distancing. But again, I come back to, if people can maintain social distancing, wear masks, that with a kind of a judicious use of working at home, and with the 3 T's, can allow offices to be reoccupied. But to go back to the density issue, that is the big issue right now. We're considering it. If what does all this mean for office demand? Do we go back to 230 square feet per worker, or do we stay at, I forget what it is now, it's about 150 square feet per worker? Do we go back there because of social distancing? Or do we and that implies increased demand in space for offices, or do companies shrink their footprint and allow people to work at home more? I think our kind of rather glib answer at the moment is that those two things net kind of, equalize each other. But I think a deeper one is that we need to run some scenarios and figure out what's going to happen. I would note that in Asia, American offices, even after a decade of densification, still look vastly underoccupied to European, Asian eyes, and that kind of Asian levels of density are extremely high. Asia is able to maintain some highly dense office occupancy, based on good social behavior and wearing masks, and they're able to, they probably able to do that because of their experience in SARS. So if I were to ask to really put my colors to the mast, I would say the trends to densification will continue, but there'll probably be a 2 to 3 year hiatus in any sort of densification. And certainly I would say that suburban office, which is accessible by private car, is likely to dominate the early phases of the next office cycle.
And we've wrestled with this ever since technology came about and the book was written, The World is Flat, and everyone will work from home, etc. So no, I like that answer. Michelle, did you want to anything put to your mind?
I have a statement, actually 2 statements here, Richard, that is like your thoughts on. It goes, I mean, it came from our audience, and the first statement is most households are on shaky grounds in terms of savings to meet emergency expenses. And then the other statement is on the business sector. The business sector, the small business seem to be facing great risk of destruction before recovery comes late 2020 and in later years probably. Your thoughts on that? Do you see, in terms of, first of all, households, American households, North American households, I must share that thought. More than half of our households are right now more than shaky grounds. They're in emergency situation. What are your thoughts on that?
I think, one has to recognize the acute economic pain that's being felt, particularly, in certain sectors of the economy, and, sectorally, it's in kind of hotels and restaurants and travel-related industries, and the folks who are associated with those kinds of they're not particularly high-paying jobs always in those sectors, so those sectors have been acutely badly hit, and there are many households that are just hanging on. There's no question, even despite the federal and the local response. You know, I think, and you know, if this, but I think, you know, if we're right, if the reopening occurs from kind of mid-June, that there is light at the end of the tunnel, and you know, as far as and people can, not everybody, but many people will be able to be re-engaged in the workforce when the reopening. A lot of businesses, you can't open a business just incrementally. Businesses are either kind of open or they're closed. So I think the reopening actually creates a lot more employment, and things will multiply in on themselves. But there is probably another month or 6 weeks out before that starts happening. So that acute pain will continue, and the chances are that there are a large number of small businesses that will fail and not recover. There is some permanent damage to the US economy, particularly in the small business sector. There's no doubt about that.
I have another statement here, and again, I share a little bit the view here. You're forecasting a GDP growth of 6.1% in 2021 in the US. This is really good given where we're starting from. How do you argue this in relative to the historical 3% or even a little lower than 3% GDP growth?
I mean, yeah, I mean, well, it comes out of a number of factors. One is pent-up demand. You know, even now, you can sense the pent-up demand. You focus quite rightly on the people who've lost their jobs and they're in you know, real economic stress. But there are a large number of people who've just been sitting on savings. And in Asia, they call this kind of revenge retail. You know, there is a kind of pent-up demand that builds up in the economy. And I think just in the corporate sector, the couple of years prior to the crisis, you'd seen a real deficit in capital expenditure. So there already was a pent-up capital expenditure demand, deficit of capital X. So I think if both of those two things turn on in 2021, kind of stimulated by various government measures, then I think that's where you get this kind of big bounce back. You know, and I think you know, once it starts, I just can't understate. It's something that economists think about, but people always underestimate the importance of economic stimulus. And it just the level of economic stimulus that's going into the US economy and will go into the US economy it's kind of historically large. So I think all of those three things together give us that uptick. Plus, just as I say, the normal cyclical factors. You do tend to get high growth at the start of the cycle as companies kind of expand extremely rapidly with demand picking up.
And I think something that ties into that, and we could be here all afternoon with some great questions coming in, is, you know, clearly the government, what they call it, you got to put on the government right now in the US, because Powell basically said, we'll do whatever it takes to make sure we do well. And the amount of money that's being thrown out there is clearly doing its job. And the question would revolve around, there's going to be a day of reckoning. You know, this isn't, they're printing money and lots of it. They're now buying bonds. BlackRock's doing that for them. They're talking about buying junk bonds. So is there a day of reckoning that when we start to get the economy back on track, what happens on the government side? And someone even mentioned, I recall back in the 70s, there was a W. So what happened was basically we came out, then went back in. So the question is, what happens with all the government spending down the road? What impact does it have on the economy? What does it mean? How do we get out of that?
Okay, if you'll allow me just to step off being CBRE's chief economist and into just being an ordinary person that can express a view, or not somebody with a PhD in economics. I think the 1970s are actually quite a good indicator. I think this economic shock is closer to the oil shock of the 1970s than any other individual kind of shock that we've had. In 1973, the oil price tripled. It was a demand and a supply shock. It brought the Western economies to an absolute shuddering halt. And you did get a W recession. I think this shock is closer to that. And the interesting thing about the 1970s is that if you look at the average growth of the 1970s, it wasn't too bad, despite the fact that you had the shock. The average growth was pretty good. What you did have in the 1970s was a very volatile period. The volatility of economic growth was pretty high. I could see the COVID crisis reverberating for another 5 or 6 years, not damping economic growth per se, but creating much more volatility, including what happens when government tries to withdraw the stimulus. I mean, you saw my chart of the central bank balance sheet. We hadn't even got anywhere near winding back central bank balance sheets prior to the great financial crisis. And now it's kind of accelerating again. My point about the Second World War and the Great Depression, they are both indicative of government spending, a lot more, being much more interventionist in the economy. And in a crisis, that has some positives, but in terms of disturbing the normal functioning of markets, that can be quite damaging as well. So a combination of those two things, could lead to volatility. And if I were really to push this, if you, and this is not an orthodox economic view, but I have heard it, and I do, I do kind of subscribe to it in a scenario. It's a plausible scenario, if not the base case, that a combination of economic reshoring of activity to higher cost locations and to locations where the labor force is actually declining, a combination of massive expansion of government debt and central bank buying that debt in a way that if the Weimar Republic did in the 1930s. Further out, 2 or 3 years out, does that add up to an inflationary cocktail? Yeah, of course it does. It absolutely does. So I've begun to think about what, luckily for us in real estate tends to perform quite well. For those of us, not that I'm one of them, but for those of us who remember back to the 1970s, we remember that cap rates can actually trend below bond rates. Mm-hmm. So I think that as a kind of an outsider scenario is worth talking about, if not the base case.
Yeah. And again, we could go on all afternoon, and we're going to be bumping up time. Is one question I do want to get in, there's clearly going to be winners and losers as we go through this recovery. And retail has been just battered, along with hotels essentially just shut down, and they are starting back up. So any characterization of, from a property type perspective, the winners and losers, especially over the next 18 months, and that can be by geography, property type, etc. But comments on winners and losers as we work through this recovery?
Yeah, I mean, I think it's interesting, just if I could just preface that and talk about winners and losers socially, because it follows on from the previous example that, over the last 20 or 30 years with kind of government light we've seen a little bit of trend towards more unequal income distribution. So, one of the consequences of government intervening in the economy to support the poor guy, or to, as far as it can, to give ordinary workers support, as they appear to be doing quite effectively in the UK and are to a certain extent in the US, is that some of that will have to be paid for out of taxation, even if we allow the government debt to kind of absorb all the excess savings in the global economy. So you've got to think that potentially some of the upper income groups are going to start to see higher rates of taxation. And if the balance of taxation becomes a little bit more progressive, I'm not certain that that will be a particularly bad thing. But in terms of winners and losers, we might see, curiously enough, the less well-off benefiting in the medium term relative to the well-off. Going back to your issue of property, I mean, clearly you've got to think that logistics is industry. If they hadn't already had a good run, logistics gets another kind of a tailwind, I think. And you've probably got to think that kind of the trends that pre-existed. Well, I think we were beginning to see a trend towards, the slackening off of the big box demand for big box logistics, because that network had been largely built out for this cycle, but still pretty intense demand for last mile delivery. But if people are going to stock up and hold bigger inventories, then you've got to see the kind of big box logistics coming back quite strongly. I think, yeah, I mean, the obvious loser is going to be retail. The stress it's clearly not going to take out grade A malls. I mean, grade A malls have been cash generative for most of the last 10 years. I mean, grade A malls are going to suffer a hit, I think, because, so many retailers have gone bust, but probably can weather the storm and bring in new retail concepts. I think we're going to see accelerated depreciation in some of the weaker areas of retail. And in the office sector, I've already said, I think that kind of, the balance of competitive advantage lies in office that can be accessed by the private car. In terms of locations, you've got to think places like DC, which are, got a high proportion of government occupier, going to be a bit more stable. And I think probably tech centers, tech employment seems to be, at least so far, more resilient. So, those centers that are being kind of dominated by tech probably, tend to be winners out of this. I think there's, clearly, medical office and life sciences gets a tailwind that favors places like Boston, and Philadelphia. So, I've been a bit kind of neutral on the losers, but I don't think we've got time to discuss those.
And again, I've been hogging up the time. I could ask many questions, but I'll yield to Michelle. But I do have one more question. But Michelle, is there something in particular you want to hit on?
Yeah, just to get on to the winners and losers. So let's talk on the winning side. So clearly on the winning side in terms of asset type. So you're looking at really the multifamily and industrial being your winners there.
Industrial, yeah, multifamily is going to get, clearly, there are parts of multifamily that are occupied by, less well-off members of society. So multifamily is not invulnerable, I don't see multifamily so much as a winner as kind of more resilient. It's not going to really, it's not really going to do well out of the crisis, but it's had a decade of outperformance, and that kind of pre-existing trend, I can't see that changing in the medium term. It's not going to win or lose out of the crisis, really. Probably a little medium term down, hit to, but not too much.
And if I could throw something in, and to me, what the government's response has done is really help the psychology of the marketplace. I think of more than anything, they have propped up the psychology. And when you break it down, it's a health crisis that went into an economic crisis that may go into a credit crisis. So the psychology of the marketplace, I see it almost bipolar. Where you have Warren Buffett saying everything is frozen. You have Sam Zell saying this economy is scarred forever. But then again, that's the negative side. And yesterday, hedge fund managers came out and said this is the most overpriced market they've seen since the .com. So you have that side. And then you have the side where the market goes up. So it's almost bipolar. And I think it's a reflection of the psychology of the marketplace. And right now, the psychology is saying, I think we're going to get through this. This is going to be a strong recovery, but it's starting to be chipped away. And so with your economic forecast, do you view that the psychology of the marketplace can hold up? I think that's the most critical element, you know, the confidence in the broader economy. So will our psychology and I guess outlook continue on to get us through this, or what?
I think it can. I think it can. I think it absolutely can. And I think if, you know, it's a bit like a patient in intensive care. You know, as long as the meds continue, then, you know, the patient can continue its recovery. And this depends a lot on political leadership. You know, you can turn a moderate recession into a major recession with policy mistakes. And so far around the world, governments have not made mistakes. They've been, you know, I mean, barring 1 or 2 months when they couldn't quite work out what was going on or didn't want to think about it. But it's a new thing. It's a kind of, we haven't seen this before. It is kind of understandable. Most of us didn't really kind of get what was going on. But I think as long as government continue to, you know, use all of the tools at its disposal to support the economy through the next 3 to 4 months, then I think the market psychology can be preserved. And I think some of the weakness this week was Jay Powell saying that we need more stimulus. We do need more stimulus, and he draws that to the attention of the marketplace, and think people realize we are. You know, the relatively favourable outlook that I'm taking, it rests extensively on government policy. Yeah. Long may it continue, and I think it will.
Yeah. And like I said, I could go on, you know, for a long period, and there's lots of questions and still a lot of people, but we're running out. So I'm going to yield to Michel and let him have the last word, so to speak, since he is our chair of 2020. And I actually told Mary that we should allow Michel to serve 2021 again, because everything's like frozen, and we should just shift his term into next year. But that's just my thing. But I'll yield to you, Michel, and let you have the last word.
All right. I didn't know you were going to talk about this, Ken. It's too bad. We had some great questions from the audience. We're running out of time. Just before the closing comments, I'd just like to maybe ask you something here, Richard, about Manhattan, about New York City. You just mentioned a couple of answers ago that in the office market, the office would be, I guess, privileged, I guess, if you can get to the office building with your car. So obviously that's a bit of an issue in Manhattan, but I have a comment here. I just want to hear a few words on that. But places like New York have laid out some specific metrics on reopening the economy. Most of these metrics have related to hospital capacity relative to COVID cases. New York City appears to be a long way from achieving those metrics. In places like this, how is it possible to forecast the timing of a recovery in the face of such great uncertainty with respect to the containing the virus?
Yeah, it's a good question. Partly, I think that Governor Cuomo will be cautious and will probably move out of lockdown probably later than many other governors. All the time the medical testing and kind of virus control infrastructure is developing. So, but ultimately, I think people will have to take a view and I think they will take the view that if we continue lockdown into Q3, we're not facing a choice between a V-shaped, a U-shaped, or an L-shaped type recession. We're facing a choice between a V-shaped recovery and a total economic collapse. And we just can't afford to do that. So we will take we will reopen the economy and live with the risks that that will entail, and we will get growth, and there will probably be some increase in casualties, but hopefully not too many. I think that's the kind of calculus that people will be thinking of.
Well, thank you, Richard. Thank you so much, Richard and Ken. I trust our viewers agree that this has been one of the finest, most informative hours of real estate dialogue we have heard in some time. The Counselors of Real Estate is proud to have been part of it, but particularly proud of your membership in the Counselors organization. The intent of our What's Next webinar series is to offer thoughtful interpretation of provocative speakers and market influencers who not only represents diverse and novel thinking of this extraordinary time, but offer informed projections and vision on what is to come. To our audience, we thank you. We thank you for tuning in and invite you to join us on June the 11th as Dr. Alexis Crowe, a highly acclaimed speaker who leads the geopolitical investing practice at PricewaterhouseCoopers, shares the steps leading companies are taking to mitigate risk and secure commercial interest across a wide industry spectrum. Watch for more details as this upcoming session and those to come in the month ahead. For more information on What's Next series and on the Counselors of Real Estate, we invite you to contact at www.cre.org. That's ORG. On behalf of the Counselors of Real Estate, thank you for attending.
Yeah. Farewell to everyone. We miss you as colleagues. So take care, everyone.
Bye.
Thank you, Richard. Thank you, Ken.
Thank you.